What if everything you've been taught about option selling is backwards? Because here's the truth: a debit trade with negative theta can win 77% of the time. And I'm going to show you exactly how. I'm Karl Domm, and I've shared my real money P&L on YouTube since 2019 through the 2020 crash, the 2022 grind down, and every market condition since. And here's the truth: across all my accounts combined, I've not only been profitable every single year since 2019, I've outperformed the long-term average return of the S&P 500. So when I tell you most option selling education is wrong, it's not theory, it's proven. Most traders believe three things. They think profit comes from the credit you collect. They think you must have positive theta to win. And they think debit trades can't possibly have high win rates. But today, I'm going to show you why all three are false. Because by the end of this video, you'll know how a debit trade with negative theta wins 77% of the time, why you've been told credit and positive theta matters, and why that advice misleads traders, and what actually drives consistent returns when selling premium. Let's break the myths and rebuild premium selling the safe, modern way. What if everything you've been told about premium selling is backwards, and the trades you are taught to avoid are actually the ones that are the most profitable? When I first started selling premium, I treated debit trades and negative theta like the plague. The guru said, never enter for a debit, never take on negative theta. You can't win unless the credit pays you up front. And I followed those rules, and I got the same results everyone else gets: the small wins and those occasional huge losses, and constant exposure I couldn't fully see. It wasn't until I stopped accepting those beliefs as facts and actually looked at the numbers that I had the epiphany. The structure, not the credit, not the theta, is what determines the outcome. And how that structure that makes it possible breaks every one of those old rules. The rule about a debit being a disadvantage. With the right structure, an opening debit does not influence the profit potential of the structure. And also, negative theta doesn't mean negative expectancy. Theta is just one variable. Structure maturity and the Greek called color can overpower that. And also, win rates come from positioning, not credit. This setup wins 77% of the time because it's engineered to benefit from time and volatility, not from collecting premium. I trade that breaks the rules. Every metric the guru focuses on, the credit, the theta, the direction, was wrong. And yet, the outcome was everything traders are chasing. Stop judging trades by the credit received or the theta at entry. Start evaluating the structure itself, its shape, its maturity potential, and how it behaves with volatility. Because when the structure is engineered correctly, debit plus negative theta is a winning formula. So if debit trades and negative theta can win 77% of the time, why have we all been told credit and positive theta are required? And was all of that just completely wrong? What if two things you were told to rely on, credit, putting on a trade for a credit, and putting it on with positive theta, are actually the very things holding you back? Most premium sellers never even question this. They hear it from the gurus, from the brokerage educations, from the forums, and because everyone repeats it, it feels like it's true. But just because something is repeated doesn't make it the real edge. Back when I was in the water treatment field, I learned something early. If you measured the wrong variable, you destroy the entire system. We had customers who judged water quality by the color alone. And if it looked clean, they assumed that it was clean. But underneath, the unseen metrics of conductivity, hardness, and alkalinity levels told a completely different story. Traders make that exact same mistake. They judge trades by surface level numbers, credit collected, and theta decay. It looks like those variables are the most important. But just like my early plant inspections, you can get a perfect looking surface with a disaster building underneath. And the epiphany hits the first time a high credit, high theta trade blows up in a volatility spike, because those numbers never protected you. They only made you feel safe. So number one, credit is not the edge. It's the proper trade structure. Number two, positive theta doesn't matter if the structure works against you. And number three, traditional old school option selling education oversimplifies because it sells more trades. This is the exact scenario thousands of traders experience every year. The data shows it clear. A good credit based setup wins small. A single loss wipes out years of theta based gains. And the 95% win rate causes large drawdowns and can significantly underperform over time. Credit didn't save them, theta didn't save them. The structure failed. Credit and theta aren't wrong, they're just incomplete. They're superficial metrics that tell you nothing about the volatility exposure and the directional exposure of your position. The only reason you've been told credit and theta matter is because it makes option selling look easy. But if they truly mattered, a debit trade with negative theta wouldn't win 77% of the time. Yet it does, because the edge lives in structure, not entry credit or theta. Stop evaluating trades by credit or theta. Instead, ask, how does this structure behave as it matures? How does the structure behave in a volatility spike? How does the structure behave in a directional market? And how does this structure behave in a whipsaw market? So if profit isn't determined by credit and isn't determined by theta decay, then what actually drives consistent returns? What if the real engine behind consistent returns isn't credit, isn't theta, and isn't even the expiration line on a risk graph? Now, back when I was trying to fix trades the old school way, I treated options like a static picture. If the expiration line didn't show a profit zone, I assumed the trade had no future. Now, using the expiration line is like trying to navigate a road trip using a single screenshot of a map. There's no movement, there's no forecast, there's no second to second update. But when I finally understood structure maturation and how a trade evolves over time, it felt like switching from a paper map to GPS with live navigation. Suddenly, the path forward wasn't hidden anymore, and the roadblocks that I used to crash into became predictable. The big epiphany: most traders lose because they're using the expiration line to forecast the future, when the future is actually inside the T plus X lines. And the hidden engine behind those lines? Color, the Greek that tells you where gamma is going next. So number one, the structure maturity drives returns, not initial credit or theta. The trade structure ages into profitability. They aren't static, they evolve. And number two, color reveals the future of gamma, which influences how the trade will behave. It's the forward-looking Greek that shows whether the structure is getting safer or riskier as time passes. And number three, the T plus X lines often show potential credit that the expiration line hides. This is the part almost no premium seller knows. The expiration line can lie to you. The T plus X lines often show the structure drifting into profitability before expiration, even when theta is negative and you open the structure at a debit. Next, I'm going to give you an example on a risk graph. And by the way, if you don't understand what a risk graph is or how it works, I have a course called Beginner's Options Mastery, and I put a link in the description so you can get it for free if you need to get that education. Okay, so this is a risk graph. Now, notice that this structure right here has profit already. It's a little bit immature, but you can see that the theta is negative. You have negative theta here. This was put on for a debit, this particular structure. You can see the expiration line's way down here, right? So you think, well, shoot, this thing is going to be down $2,500. We're going to lose money because it's going to go towards the expiration line. Well, that's not what happens. Look at the T plus X lines, the T plus 0 line here. This is the 0 days. Then you have this red line here, which is T plus 29. This is what's going to happen in 29 days. Now you have the T plus 58 days. Here's where it's going to look in 58 days. And you have the T plus 87, this gold line here, what it's going to look like in 87 days from now. So you can see the more mature the structure is, the more profit potential it has, even with the expiration line down below where the actual price is. Now, these lines are the third order Greek called color, which is the future of gamma, and gamma is a second order Greek. You've probably heard of gamma quite often. So for example, here, this is a real trade. I opened it on January 27th, 2025, opened it for a $4.95 debit and negative theta of minus 5.85, minus $5, $6 a day. The price of SPX was $59.82. This is the actual for real trade. The same real trade I closed exactly 1 month later for a credit of $10 and positive theta of 49.72. And the SPX price was 59.72. Just a 10-point move in SPX. Basically, the market didn't move. And I closed this position for a $7,500 profit. So that is my real execution right here in red from my TOS account. This is proof that the right structure can be open for a debit and negative theta and without any adjustments and profit. Now, if you want consistent returns, stop managing trades off the expiration line and stop relying on credit or theta. Start looking at a structure maturity, the color, and the T plus X line evolution. That's how you know whether a trade is drifting towards safety or drifting towards danger as it matures. So now you know what actually drives consistent returns. But there's still a bigger challenge traders face. How do you build a system that stays intact when volatility spikes or the market crashes? And yes, your next video answers that exact question. And the thing is, everything you've learned so far won't work unless you fix this one problem that blows up more traders than anything else. It's relying on the old, unsafe way of selling premium. And in the next video, I'm giving you the exact trade structure that solves this problem. The same structure I use to stay hedged, to avoid blowups and keep compounding safely. In the next video, I'll be breaking down the deadly mistakes that sabotage even skilled option sellers, and I'll show you the exact safer crash-proof structure that eliminates them. So click on the screen to watch the next video called Crash-Proof Option Selling, the safer, easy way to sell options for income, and learn the actual trade structure that I use that has a 77% win rate without a credit and without being put on with positive theta.